Welcome to The Business Behind Your Business, the podcast where we delve into the financial strategies and insights that drive success for small and medium-sized business owners. I'm your host, Paul Sweeney, and in each episode we bring you expert guests who share practical advice, real-world experiences, and actionable tips to empower you on your business journey. Whether you're a seasoned entrepreneur or just starting out, get ready to uncover the secrets to success and gain valuable insights into the business behind your business. So what if the biggest payday of your life is just around the corner? Your business is evolving. It's time to cash in on all the hard work that you've been doing over many, many years. There's just one problem. You're not ready. You're not ready to sell. Your business is not ready to sell. And that means you could be missing out on the biggest paycheck of your life. So in today's episode, we're going to uncover the strategies to dramatically increase that value, improve the process of selling your business, and make sure that when time comes to sell your business, you are ready for that event. Whether you're planning to exit now or you just want to be having a more resilient business that is more profitable, this conversation is going to change the way you think about your business. So welcome back to the Business Behind Your Business podcast. I'm your host, Paul Sweeney. Today, we're going to be joined by Cameron Bishop, who's a seasoned executive entrepreneur who's been working with business owners facing this dilemma of how they actually get ready for exit. And look, Cameron's got a lot of experience in here. So what we're going to learn from him today is how we're going to prepare our business for sale, even if you're not ready to just yet, what buyers are looking for when they're considering the value of your business, and some of the costly mistakes that prevent business owners from selling at a good price and how you can avoid them. Look, Cameron, as I mentioned, seasoned executive, entrepreneur, business advisor with a track record of helping business owners grow, transform their companies, many industries. He began, interestingly, in the publishing industry, where he's led that publishing company, Intertech Publishing, from just a small operation to a $400 million global enterprise. And he's then founded and started a number of other ventures along the way. So he's well equipped in this idea of transforming a business and getting it ready for sale. Today, he's using that expertise to help business owners just like you prepare your business for a successful exit, maximize the value. His current enterprise is raincatcher.com, and they're focused on maximizing the business value for sale. Look, you'll see how passionate Cameron is about this topic, and I'm delighted to say, Cameron, welcome to the Business Behind Your Business.
Great. Thank you so much, Paul, for having me.
Look, it's a delight to have you here. Kindred spirits here because we're both passionate about this topic. Why is it so important to you to help business owners maximize the business sale value that they can achieve?
Yeah, as you mentioned, Paul, I spent my career mostly on the buy side, running companies and doing leveraged roll-ups for private equity firms. So across my career, I acquired for PE firms about 50 businesses, spent about $500 million doing that. And I saw so many cases where these business owners literally left money on the table because they didn't properly prepare their company in advance in order to sell it. And of course, I was the buyer, so it wasn't my job to tell them that I could have been paying them $1 million, $2 million, $3 million, whatever it might have been more, if they had taken the proper steps in order to plan and prepare for an exit. Many of them also did not use any kind of professional representation, like an investment banker. So they were left kind of at a disadvantage normally for that. And over time, I saw that there was a need for help for these people to provide them more information. Thus, my efforts in appearing on programs like yours, where I can send that message. And today I work as an investment banker representing these small companies and helping them through that process to a proper and maximum valuation exit.
That's great. So look, let's just clarify a couple of things. So you're looking at it as an investment banker for small companies. Traditionally, when a lot of people look at the mergers and acquisitions, they're thinking big, 6-7 figure, hundreds of millions of dollars. But it sounds to me like you're actually focused on, I guess, the sweet spot of businesses that are really underserviced, that smaller market. Is that correct?
Yeah, you're absolutely right, Paul. Today, There are so many business owners who are aging out. I think in the United States, the statistic is 10,000 baby boomer generation people turn age 65 every day. And so many of them are business owners. And their children today don't want to take over the family company. So it's their primary source of generational wealth. So they often are left with one choice, and that's to sell the company. And they're doing quite well. They're kind of, in our case, lower middle market in US dollars, 2 million to 10 million in revenue. The smaller brokers don't really, most of the time, have the expertise to properly represent them. And big investment banks, these companies are just too small. So it's an underserved sector, but these people, their businesses will sell often for 5 million, 20 million, 30 million in what we refer to as enterprise value. That's a lot of money in my book. I could retire quite handsomely on that kind of money. So we try to help them through that process, which can be very complicated.
So I think, there's that aging population of business owners, and we're seeing that trend worldwide. I think in Australia, the number of business owners over the age of 50 is significant. I think it might even be half of the number of small, medium business owners. We're seeing that trend worldwide. A lot of them, as you said, the children don't want to take over the business, so they've got to look for some other way of selling. What's some of the most important factors or things that we need to concentrate on? Because I see a lot of business owners, they make that decision to sell, might be at a particular time of the year, might be end of calendar year after Christmas, it might be end of financial year, but suddenly they've made a decision, or it might be a significant birthday, but they've made a decision that they need to exit their business, and then all of a sudden they've turned around and come and had the conversation. They say, Cameron, I want to sell my business, what's it worth?
Yes, we hear that all of the time, and their expectations on what it's worth are very rarely accurate with what market rates are. But really, Paul, the first thing they have to do is realize that they have to plan in advance for this process. Everybody is going to exit their business one day, one way or the other. And it's a long-term process. The sad fact is, and it's human nature, most business owners spend 95 or more percent of their time working in their business and 5% or less of their time working on their business. And there's a big difference in terms of how you create and extract maximum value from the company. And that requires you to focus on how you structure the company and prepare it for an exit. And you can't just wake up one day and say, hey, I'm going to sell my company. Well, you can do that, but you're never or rarely ever going to get a maximum value for that. You need a runway for that. A year, 2 years, 3 years, ideally 5 years out before you decide to actually run a process, which typically takes about 9 months from when you actively begin to package, market, and sell the company.
So you're saying 5 years. Now, that's a lot of time in advance. I'm guessing we're putting in place quite a significant plan. What kind of values are we leaving on the table by not starting early? So let's say I come to you and I think my business is worth 2 million. What do you think that the average value that we're missing out on by just leaving it to the last minute to make that decision to exit the business?
Well, sometimes it's a great question. And sometimes, sadly, the answer is that their company is not going to be sellable. There are many, many factors that are sometimes specific to an individual industry, but the primary kind of macro factors that we need to look at as business owners and that buyers are looking at are, first and foremost, to have really high quality, accurate accounting, hopefully done on an accrual basis rather than a cash basis. The second key factor we look at is the degree of dependency that the business has on that owner. If the business, the litmus test is, as the old saying goes, if the owner got hit by a bus, what would happen to the company? Buyers want to know that, because while buyers are willing to take risk to buy a business, at the same time, they are also very risk averse And one of the things they look at is whether or not the company can run successfully without that owner. So part of that runway leading up to a sale process is, do you have any kind of a succession plan where there's a manager below you who has the expertise to take on and continue to run the business?
So there's a couple of things you mentioned there. You're talking about good accounting records as a first step, the level of dependence on the owner, and a succession plan. Three key things which I see missing in a lot of, well, the dependence on the owner is the one thing that's always seems to be there, but three key issues. Do you want to expand on that a bit? You mentioned accruals versus cash basis for accounting. Let's just clarify, what do we mean by that, and why is it important to have the distinction there?
Yes. Again, great question. And many of these owners don't understand accounting to the degree where they can differentiate. So the real key factor is the vast majority of buyers, when they look at a business, want to see what the true gross profit in that company is, because every industry has different kind of benchmark percentages. And if they're on a cash basis, they're not aligning the costs that they're incurring to create or manufacture or deliver their product with the time when that cash comes in. They're misaligned. So it's either difficult to impossible to really understand what the firm's gross profit margins are. So on an accrual basis, the costs line up and are attributed when the revenue is recognized, and that creates gross profit and a gross profit percentage.
Yeah, absolutely. A couple of local examples that come to mind there is, and this dates back to some of the COVID incentives that were available for Australian businesses, where they were allowed to write off the value of a capital item as an immediate tax deduction. Many of these businesses didn't keep a distinct accounting and tax depreciation schedules, so they just did their accounting depreciation with the immediate write-off. So they have this big loss in the company because they've accelerated the depreciation. It's not matching the timing of the expense going forward. And I see another one where we have annual submissions of, so I was talking to a client recently, they've had an annual submission of payroll tax instead of paying monthly as they go and matching the expense to the period. But the timing of that annual payment went into the next period, distorted what their current position is, but also didn't give a true picture of the previous period. So it's important to get that right. And many business owners, I find, don't understand that distinction.
Yeah, very true. And, many business owners don't really focus much on their accounting at all. And the value of accounting expertise, either with a really professional controller or a CFO, they can be worth their weight in gold in order to fully and accurately document that and create pro forma structures and add backs, which allow the business to show its optimum profitability.
Yeah. No, key thing, we've got to have those accounts right. You talked about, I guess, dependence on the owner, and you say about taking the owner out of the business and there's being nothing left. We seem to have that as a badge of honor in my generation. It seemed to be a badge of honor that as the business owner, you knew every customer, you knew every supplier, you knew how everything went, and every decision came through you. But that's actually, from what you're saying, is actually really hurting the value of our business.
It certainly is. If the business owner has, let's say, key technical knowledge or unique knowledge or information that is germane to the business and nobody else in the company has that, if a buyer wants to buy the business and the owner wants to retire, where does that knowledge come from or go? And that can be a real deterrent or a red flag for potential buyers for the business. The same goes with customer relationships. If the owner is the key owner of customer relationships, if they leave, oftentimes there is no ongoing loyalty, or again, buyers can see that as a significant risk. That's why owners need to be able to understand how to create a succession plan and implement that and train the people underneath them who could step in once they choose to leave the business, because in almost all cases, that owner is selling because he or she wants to retire either immediately or sometime in the not too distant future. And buyers want to say, how do we run this company without that individual?
So succession plans are sometimes, I guess, a stumbling block for a lot of business owners, particularly the smaller ones with low headcount. How have you seen this work really well in some of these smaller businesses that you've been working with?
Yeah, it's oftentimes tough for these business owners because it means they actually have to invest back into their business. If they don't have an identified successor and they need to add a headcount position at a middle to senior level manager underneath them, that's money that's going to come out of the bottom line for the company. And they oftentimes don't understand that there's usually a very significant return on that investment when they finally sell the business, because there is that successor in place and buyers are less hesitant to reduce the price they're willing to pay for the business in order to kind of offset what they see as that risk there. But that's another example of where owners need to work on their business as opposed to just simply working in the business.
So a lot of people will think that succession plan, they'll look at immediately at the cost of that extra labor, the cost of that extra headcount. But you've mentioned it's a significant investment and the returns are greater. For a lot of business owners, they're just focused on that cost as a way of, I guess, deciding not to go ahead and develop the succession plan because it's going to cost me too much. But you were talking about it as an investment and significant returns. What are those business owners missing when they're looking only at the cost?
Well, again, sometimes they don't understand that if there is significant owner dependency, buyers won't buy the business. They're not sellable. So there's a significant ROI just between having an unsellable business and a sellable business. In less extreme circumstances, buyers, again, while they are willing to take a risk to buy a business, they are at the same time risk averse. So they're going to mitigate that risk by either paying less for the company or creating a deal structure which is far less attractive to the business owner who's trying to sell that business. So it can be a two-edged sword in terms of what their ultimate take out of the business is without a proper replacement for that owner once he or she leaves.
I think a counter argument that a lot of people are going to come up with, and I've certainly heard this myself, is that I can't afford to pay somebody else in that role because that's going to reduce my profit, which will reduce my value. But I think that's only going to be the case if we start within a short period of when we're planning to sell. You're talking 5 years out. Would that be a fair assessment of why people stop?
Yeah, it's a very understandable concern for these business owners, for sure. And as I use the benchmark of 5 years, that's in a perfect world. In our world where we are representing these company owners to sell their company, we'd be very happy if they started planning even a year ahead, much less 2 years ahead of the process. We'd consider that a luxury in order to help them maximize the value when we package their company, do the marketing materials, and reach out to potential buyers for that business. So any of that can create a return on their investment.
So, yeah, that's great. We've talked about some of the significant mistakes people have made. So leaving it too late to make that or to prepare their business, not having accounting records, dependence on the owner, no succession plan. Are there any other major ones that you've come across which are sort of the big issues that we need to deal with?
Yeah, there's 2 or 3 others that are primary. So again, in our business, when we're out marketing a company for sale, we send out an anonymous teaser about that business, and interested buyers contact us. We have them sign a non-disclosure agreement. Then we do a video interview with them to vet them and make certain that they are legitimate potential buyers for the business. And so once we've done that, they begin to ask us questions. So again, first, they're going to ask about accounting. Second, they're going to ask about owner dependency. The third question we get, which can be an instantaneous disqualifier in almost all cases, is what is the level of customer dependency in that business? And the standard metric is if any business has more than 20% of its business dependent on one customer, most buyers will automatically disqualify that as a business that they're willing to look at. Of course, if it's 30, 40, 50%, we've seen clients that had 80% of their business dependent on one customer. And you're just not going to find buyers for that business. And one quick, simple story, I had a client that owned a marketing agency. One of the first deals I did almost 5 years ago at Raincatcher. Brilliant guy, very creative, won tons of awards. So he had heavy owner dependency because of his creativity. But he had a hospital chain that had like 30 locations. And his argument was, well, I have 30 different customers. But the buyers all looked at it as though he had one customer. And we had 6 offers for the business. No one would offer him any cash up front for fear that that big client would leave. And he got angry and he walked away from all 6 offers. And 6 months later, there was a change of management in the hospital chain and they fired him. So he lost 50% of his business and he was literally at that point unsellable. And that's the reason buyers look at the degree of customer concentration in any company they're looking at acquiring.
Yeah. That is such a major issue for a lot of businesses, even ones that are not planning to sell. I think that risk of having such a high degree of customer concentration, it can be devastating. We've seen a lot happen with, I guess, the smaller end where the contractors who are depending on a large builder for 90% of their income, and suddenly that builder's gone into difficulty and they've lost their whole business. So there's a cautionary tale there for every business owner, even if you're not planning to sell your business, is to have a look at how concentrated your customer base is.
You're absolutely right. Similarly, there is a factor around vendor concentration. So if you have a business that is heavily reliant, or worse, solely reliant on one vendor for some kind of materials that you use to create or manufacture the products that you sell or that is required in your business, oftentimes buyers are not willing to take that risk. I had a client in Canada who utilized a very unique product that was only manufactured by one company. And the company was solely reliant on that material from that one manufacturer. And we had extreme difficulty finding buyers for the business because if they lost that vendor relationship, they had no company. So that's another key thing that buyers will look at.
Some great points there about things that we need to be mindful of in actually assessing our business, and not just when we're going to sell, but some great points there about things that we need to do to, I guess, de-risk our business for an ongoing basis. Quite a lot of value there in what you've provided today, Cameron. Quite a lot of, I guess, cautionary tales there of why people get this wrong. If there was one thing that you suggested people must do if they did nothing else, what was that one thing that they should do now?
Sure. Well, this is a little bit of a shameless commercial for what I do in life, but when I used to run companies for 35 years, one of my key takeaways was know what you know how to do well and do it. Know what you don't know how to do well and find an expert to do it for you. So in the world of selling companies, the vast majority, 90% or more, have never sold a company. They think it's the same or as simple as selling the products or services in their business, and it is absolutely not. An investment banking professional will far more than pay for themselves over the course of the 9 or 10-month process it takes to sell a company in terms of what they could do to bring buyers to the table, to maximize the valuation on the business, and navigate through the extremely complex terms and criteria around balance sheets and net working capital, because the price of a deal isn't always the price at the end of the day, based on what the owner will realize without that kind of professional help.
Yeah, no, that's great. I know we said one thing, but there's one key point you just added there, which I think a lot of people have missed or miss completely. Is you're talking about a 9 to 10 month process for selling, not a one week to 1 month process. You're talking it is a long process. Get the right advice from somebody who is experienced in selling businesses, so they'll get a better outcome for you, and that better outcome will far exceed any cost that you might be balking at. Get the right person involved in the process, the right person on your team to help you get the best result. Get in contact with the right person. And speaking of the right person, Cameron, how do our listeners get in contact with you?
Absolutely. Please feel free to email me at cameron.bishop@raincatcher.com, or you can find me on LinkedIn. Our corporate website is www.raincatcher.com.
Fantastic. Look, as always, we'll share links to those ways to contact Cameron in the show notes and also on the businessbehindyourbusiness.com website. It's been absolutely fantastic to talk to Cameron today, because he's really highlighted some of those key steps in some very clear explanations about why you need to take those steps now, even if you're not thinking of selling a business, but why you need to get started today. Cameron, it's been an absolute pleasure having you on the Business Behind Your Business. You've provided some valuable content for our listeners, of which we are truly appreciative. Thank you again.
Paul, thank you again so much for having me. It's been a pleasure.
That's a wrap for this episode of The Business Behind Your Business. We hope you found today's discussion insightful and valuable for your business journey. Before we go, don't forget to subscribe to our podcast on your favourite platform. Share it with fellow business owners who could benefit, and send in your burning questions, because we love hearing from you. Missed any of our previous episodes or looking for additional resources to help grow your business? Head over to our website at thebusinessbehindyourbusiness.com. There you'll find our full archive of past episodes, along with show notes, transcripts, and links to valuable resources mentioned in each episode. Your journey to business success continues at thebusinessbehindyourbusiness.com. Until next time, stay inspired, stay informed, and keep building the business of your dreams.